Well, talk about markets, valuations, opportunities, gold and silver. We are now joined by Raamdeo Agrawal, someone who needs no introduction whatsoever. He's a true value investor, and over the years I've interacted with him. I've always learned something new and admire his ability to really look through the noise and look at the big picture. Mr. Agrawal, good morning. Thank you for joining us. Hope all is well, safe with you and your family.
Everything. Thanks, Nikunj, and very good morning to you.
As a professional anchor, I normally start with a very pointed question with you whenever we start an interaction, but this time let me do it differently. I'm going to give you a choice. Do you want to start with why Berkshire has bought into gold, or do you want to start with why banks are raising so much of capital, or should we start with something on value investing?
Well, let's start with Berkshire. I think that's something less domestic, more international and thematic. You know. So I was reading
Fair
about
point.
it.
So,
yeah. Please go ahead.
Yes, please go ahead.
No, my thought process is that Buffett, in his wisdom, he's trying to change himself with the change of the times. He denounced aviation stocks for 25 years, and then finally he went and embraced all the 4 airlines, all 10% each, and then finally he sold it out again at a loss. So I only hope gold doesn't become same kind of a trade for him.
Fair point. But is there a big departure in the way how we should value assets now? I guess that's the question which we need to address, because when interest rates are at 5 to 6%, some would argue gold may be an instrument just to beat inflation. But when interest rates are zero, at least in developed markets, at a record low in India, do you think gold becomes more like an investment rather than a hedge? And that's a big difference. Gold becoming an investment rather than a hedge changes the entire portfolio allocation for everyone.
So it's a very gold has become in a zero interest rate, zero inflation environment. So not only the interest rate is zero, inflation is zero. So in that environment, because earlier our thinking was that gold is a inflation hedge, but there's no inflation. So there is no logical, there could be liquidity. There is no other place to park the money. There is no bonds. So, but gold is not a yielding asset. And maybe there is a fear of inflation coming back, but that fear is going on for last 10 years. So I don't have any extra insight that inflation is imminent. I don't see anything else. There is no other reason why should gold go up. But maybe the wiser people like Buffett and all, they'll give, or maybe they're fearful of inflation coming back, which I don't have any clue. So I learned one thing from him: if you don't understand something, don't do it. So I would still stay in the on the side of not understanding gold. So I would rather stay away. That would be my way of saying it.
Fair point. Thank you for that honest answer. I have just one more question, which in a sense has been puzzling everyone, which is that you are in a market where equity, which represents risk and also productive gains, is at a record high, and gold, which represents a hedge and a fight against inflation, is also at an all-time high. It's rare that both these assets, Raamdeo ji, they rally together. How should an ordinary investor read into this trend? Because they both are very contradictory in nature, aren't they?
Yeah, I think both are being driven by very different forces. I would think that gold is driven, gold prices, bullishness in gold prices are driven by fear of inflation. There's no inflation. There's actually deflationary pressure, but there's a massive fear of inflation. You cannot fight with the fear. Fear of anything you cannot fight. So there is a fear of inflation, and there is no any evidence of inflation on the ground in the global markets. Whereas equities are being driven by the fact that there is no yield in the bond side, or bond is a 10-year paper is trading at say 60 basis point. So actually, effectively, the bond P is really 150. So what is the harm in buying equities? I mean, basket of equity, like I'm talking about indices at 20-25 P multiple, which also has growth and 2.5% dividend yield. So that's the argument for stocks against bond. So which is very logical so far, and liquidity is also there. So clearly, because of that, if you see the performing part of the equities in the world, whether it is FANG companies or whatever companies are performing, you see the growth included, the valuation of equities are going through the roof because the bonds. So I can see the bond versus equity argument, but I don't see unless there is this fear is well thought through that yes, there is imminent upsurgence of inflation in the world. I mean, with conventional thinking, yes, money eventually someday inflation will raise its head, but I'm not that competent.
Mr. Agrawal, equity market perhaps is the only market where you can buy gold at the price of silver when the sentiment and market conditions are bad. Similarly, it is the only market where you can sell gold at the price of diamond when there is euphoria and when there is mass participation. So where is equity market right now? More towards silver or more towards diamond in terms of valuations?
I mean, I would say we are talking about broad valuation. So broad valuation at about 65% to GDP. I mean, we are at about 152, 153 lakh crores market cap on a 200 plus crore kind of GDP in the current year. So I don't think we are in a very frothy valuation market as an aggregate. But yes, there could be pockets of diamond valuation also, and there could be pockets of brass valuation. Forget about silver valuation. So always market is made up of all sorts of things. But I don't see that kind of exuberance what we saw in 2008. We have seen three of them. No? In 92, we have seen, I mean, you don't have to ask whether markets are overvalued. You don't need these questions. In 92, in 2000, for tech companies, in 2008, for the broad market, my market cap to GDP, Nicole, let me remind you, was 180%. What is US today was India in 2008. My market cap was 73 lakh crores and my GDP was 45 lakh crores in 2007-8 when we picked out. Today, my GDP is 200 lakh crores and my market cap is 152. Yes, there can be a pockets a little bit here and there, but I don't think broad market is that badly off.
Lot of question marks have been raised on where financials are headed. Banks have raised money. Banks are also of the view that in the short term the sea is turbulent and the boat will shake. So how should investors look at it? First bad news will come and then good news, or right now banks is something which is a difficult category to call?
Right now lenders as a category is tough. It is very tough to figure out what is going to be the credit cost, because all the banks go down all over the world in the entire history is because of bad loans. So this time, I mean, to be fair with them, it is not because of they giving very bad loans, but a reasonably large size of good, okay kind of loans will also become bad because of COVID and the effect of COVID. So authorities are doing all kinds of measures. They've given moratorium. Now they're talking about restructuring, rescheduling, and all sorts of things are happening. But still, if economy has slumped by 5-7%, and who knows how long this entire thing will last. So there will be damage to the banking portfolio. And hence, this is not the best time for the lenders. I mean, last 6 months has been challenging. And I think next 1.5 years will be challenging. So clearly, these are not, I mean, rosiest of the time for them. But at the same time, no economy comes back without a strong banking system. And hence, there is a tomorrow. There will be there will be a lot of support from RBI and government in every possible form to bring back the bank to the healthy condition. And hence, if you are a little longer term in 3 years, 5 years, I think if you get good banks, and good means truly the best banks at reasonable price, I think they still would be good investments for longer term, not so much for the shorter term.
There is going to be a change of guard at HDFC Bank, a bank which all of us have admired for its leadership. As a long-term investor, someone who's been investing and has invested in HDFC Bank 20 years ago and 20 days ago, how should investors look at the change of guard at HDFC Bank?
See, the way I'm seeing, Nikunj, is that if the bank is the world's one of the finest bank created in the last 25 years, and the leader has chosen the next successor and has groomed the incoming guy for 25 years under his own direction, I mean, you can't ask for any better transition. And transition is part of the life. If you want longevity of any corporation, then, I mean, he could have been given another 2-3 years, but beyond that, again, the transition thing comes. So you have to face it one day. Unfortunately, you're facing it on the COVID time. But that shows the strength of the bank, that the culture, the opportunity, the value migration opportunity which is there, and the way they have conducted, the way they have built the book. So the strength of the bank will come at this point of time to help transition smoothly. I mean, one point is very clear, that whenever the large, kind of larger than life leaders, they transit, it becomes little difficult to match up with the expectation from the next guy. But when the next guy comes and when you start flashing his interviews and reports, I mean, I have seen people with a very little public profile, they suddenly become like everywhere. So I would say that this transition should not be very difficult, and all the strength of HDFC Bank and the preeminence position would be of use. So I would be watching very closely, but that's fine.
Okay, one of my favorite lines from your wealth creation study is that for a long-term investor, you need vision to see, courage to buy, and patience to hold. And patience is the most difficult virtue. Now, in your career, you had vision to buy Hero MotoCorp. You had courage to invest in a stock like Bharti when it was not making money. And you had patience to buy HDFC Bank. So vision, courage, and patience, they beautifully marry in these three stocks. But what we are talking about is history now. Let's apply the same theory. Where do you have a strong vision? Where do you have the courage to buy? And where do you have the patience to keep?
See, good thing is that future doesn't unfold in one day. And there are, I mean, if you remain optimist, there are so many opportunities. It's a waves of opportunities in the global economy. So when I started in 87, 88 or till 90, we were very small. Economy was primitive. We were all closed. We had not seen even books, forget about anything else. So we didn't know what is the world of opportunity. And then 92 opened up everything. 95, 96 opened up India to the software world of the software export world of the global markets. You see, in 95, 96, there was not even a deal of exports. Today, we are knocking the door of $150 billion of exports. We are digital power in the world. So, this has happened right in front of us in the last 25 years. So, a lot of opportunities, they keep coming. I mean, there was no generic pharma companies. It started with Dr. Reddy and Ranbaxy, and then Sun followed, and Lupin, and a whole lot of them. And today, we are pharma capital of the world, and still counting. So, a lot of these opportunities, they keep coming in some kind of a wave after wave. Now, pharma, all the API companies and all, they are kind of flying. And then at some point of time, you'll find the e-commerce companies, the online companies, they will start coming. They are still in the private equity space, but I don't have any doubts that a lot of new ventures, new promising enterprises which are driven by digital power, they may not be digital companies, but the existing businesses will be empowered big time by the digital processes. I think those businesses will win big time, and there will be the opportunity in the years to come. What I'm saying is that opportunities keep coming. We have to be ready to embrace them when it comes and encash on them and build on them. And you have to be early in the game. You have to be ahead of the crowd. So when you buy, when I bought Bharti in 2003, people said that this is very capital intensive. It is not your type of company. But you know what happened in 3 years? I mean, in next 3 years, it went up by 50x. The demand for cellular phone was going at 100% per quarter or almost per year. So, you know, those kind of, because this country is large country. So whenever any opportunity opens up, it opens up very rapidly and scale up very quickly. So any successful company at the early mover, they make a lot of money. And so post-COVID also, we are hoping that we'll find one or two big nuggets in this entire confusion.
But having said that, if I look at the last 10 years of corporate India, only 3 or 4 great companies have got created. DMart, Bajaj Finance, Indigo. Barring that, in last 10-12 years, we've not seen birth of a great company. So we may talk about India's potential, demographics, entrepreneurship, skill, scale. Last 10 years, there has been a drought of new companies.
I agree. But a lot of them they stayed in the private equity. I can tell you, very large companies, successful companies, they have not come for capital raising. They have stayed in the private equity, or they have gone to, say, like Flipkarts of the world. They have not come here. So e-commerce oriented companies which are ruling the roost in NASDAQ and in China, that has not happened in India so far. They have remained in the private space, and they're relatively small right now. I believe there are 15 to 20 unicorns, and we are expecting many more unicorns in next 5-6 years. Somebody was saying, I was hearing that Indian digital infrastructure is 100 years ahead of physical infrastructure. So clearly, that is going to throw many more companies and many more competencies which will help the existing businesses. So maybe the new companies will not come, but the existing companies can harness the power of digital.
Fair point. So how can an average investor who does not have appetite, capital, or even the understanding of buying PE can participate in India Great Digital Highway? I mean, everything will have a digital touch piece, whether it is the end piece or whether it is the beginning piece. But digital is like food and air to today's world. How can one participate?
Yeah, so whatever is available in public market, you can definitely participate. Like first flush of it, we have seen in emergence of Reliance as one of the digital powered company, I would say, and possibilities out there. There are a lot of possibilities. So like that, many more opportunities will come. We have to be patient till it comes to you, because in listed space you cannot force yourself. In private space, yes, but in listed space, or you have to go abroad in the sense that you buy something which is listed abroad. Nowadays, it is much easier to buy a lot of foreign stocks. So you can directly participate into buying Zoom or Tesla or whatever, these kind of things, or Microsoft or FANG. So, and actually we don't have many actively managed technology companies for the global investors. So you can buy into NASDAQ ETFs. So you can diversify your portfolio, embracing more the digital power of digital in the years to come.
The chemical companies, Mr. Agrawal, some of them which currently are in a stealth bull run are 15 years old, 20 years old. Their models have not changed. Most of the chemical companies are still dependent on the volatility in raw material prices. They don't have too much of IP, and they are still a B2B business. But why are markets suddenly valuing chemical companies like consumer companies? And do you think the bull run in chemical or specialty chemical is here to stay?
Because actually, I'm not been very successful in picking up a lot of chemical companies for the very reason you are saying, because it has been always up and down. But right now, because of confluence of a lot of events like this Chinese affair and Chinese themselves going away even before pre-COVID from chemical sector and leaving this opportunity for countries like India. And then now there is a import ban and import restrictions and all. So that has opened a much larger opportunity. And more than the volume, it is the margin opportunity. Suddenly margins have shot up in a lot of chemical products. Whether that is sustainable or not, I'm not competent to say that. But generally, if the nature of the product is commodity and somebody is making extraordinary profits, I'm quite sure, forget about Chinese, Indians themselves will come and bash it up and take away the margins. So I don't have any doubts if the companies don't have IPR or effective entry barriers, whatever reason. I don't think those profits will sustain, but I don't have any comment on a specific company on that.
Where do you think seeds of a next bull market are getting sown? You know, in 97, 98, if you bought TMT, you hit a home run. Then if you bought commodities and infra, you had nothing to worry. If you bought financials couple of years ago, a combination of financials, NBFCs and consumer companies have made money. What will create wealth? I'm not talking about today, tomorrow. What will structurally create wealth in this decade?
I think well-run companies, well-run enterprises which have proven their capability to see. One is a new frontier, completely new frontier, which comes, say, post-COVID, something will become very hot. Very popular. Say, like all the work from home kind of companies or telecom companies or digital companies, few companies. So there'll be one segment where you see very high growth. And wherever you can seize an opportunity, you must put some money. But the old successful companies, I think they will continue to do well as the economy grows. Whichever way the tailwind is there in the businesses, you will find, say, like auto companies. When the economy grows at, say, 7-8% again in next 5-6 years, you're not going to give birth to new auto companies. They are going to be same companies. In fact, if there are 5, it will become 4 or 3. And hence one paper I was reading, 10 years in 30 days. So what is happening is that there is a lot of adoption of online business model. And the second thing is the corporate profits are becoming much more concentrated. Pre-COVID, almost 70% of the profit was earned by 10% of the corporates. Now it is predicted that 90% of the incremental profit will be earned by 10% of the corporate at the cost of the profit or profits of the smaller corporates. So the consolidation of the profits and the corporate activity will be very intense going forward. And there will be few winners of that. And they are not going to be the new companies. They are going to be the old established companies. So you have to be, my sense is the opportunity is going to come there, where stocks are reasonably priced. They are proven good companies, but the companies have capability to seize market share from, say, something is 50% market share. Can you take it to 70% market share? And there you kind of squeeze the consumer and make a lot of money. So I think if market has not priced it well, that's where the opportunity I see.
Okay, 2 more follow-up questions, and I'll talk about an equation which all of us understand, that market price is a function of EPS, which is earnings per share, and into PE. I'm just breaking it for our viewers. PE is perception, EPS is earnings. Where do you think, Mr. Agrawal, there is scope for PE expansion in the market, and where do you think there is going to be a great EPS recovery? The ultimate combination, you get both. But if you have to point out EPS recovery stocks and P re-rating candidates.
Yeah, so right now for 2021, we don't have clue how much will be the decline in the corporate profits. So if by chance we take last year's as a base, about 500 rupees EPS for Nifty, and we think that Nifty is about, say, 10,000 or say maybe 11,000. So we are talking about of a normal EPS, we are talking about 2022 times. So clearly, the P multiple expansion can be limited, but I can tell you, Nikunj, by chance India gets into 7-8% kind of growth trajectory. Right now, the challenge is to even go to positive territory. But if by chance again we trek back for a few years to 7-8%, 9% growth, that potential stays with India. If we get into that, I won't be surprised that even the P multiple of the index goes to 30p, 28, 30p for some time before it comes down to again 18, 20. So there is if the earnings come up in a low interest rate and a massively liquid global economy, I think we have a good scope to go up in terms of P multiple. Today, Nasdaq Composite is trading at 60 P multiple, and Dow is trading at about 23, 24. So what I'm saying is there is a scope for growth economy. Are we growth economy? Are we going to deliver 7% growth in the years to come? My sense is that potential stays. What will bring this Lollapalooza or the confluence of factors for India to propel forward? That one has to wait, and that's where I remain optimist that yes, it will happen, and it will happen when nobody is expecting it.
Well, it's always triumph of the optimist, isn't it? In equity market, like our common friend Rakesh Jindwala says, that 90% of his wealth has been made by remain invested and by staying invested. I want to bring this point out for our viewers, a conversation which we had with Mr. Raamdeo Agrawal right after the COVID crisis. And when I asked him that if you're bearish, why are you not raising cash in your portfolios? He said, look, I'm not good at market timing, and trust me, when the recovery will happen, all those folks who are sitting on cash, they will be running for cover and raising cash. That is what has happened. In equity market, most amount of gains are made when you are in the market rather than timing the market. I'm just saying it because we keep on bringing this point for our viewers out, and sometimes this entire fascination of timing the market just does not go through. Okay, Mr. Agrawal, we'll not extend our appointment. We can go on with this interview. My last question is that in America, Robinhood investors are back. In India, retail investors or hobby traders or work at home investors are back. Historically, we have always said, okay, retail is back, that means it's bad news. That means non-sophisticated investors are making the market top. But do you think this time it's different because of technology, information, and other things also? The retail guys are also quite informed and mature?
No, if you see the massive influx of retail, that has happened post the collapse after the month of March. So from the bottom, when the world was trying to, all the subsequent investors were sitting on the fence, or they were taking, they were redeeming, they were fearful. I think retail investors were the one who actually propelled the market up. So they have done very well in the last 2-3 months. But it all depends. As I said, nobody knows where the market is headed, and now the margin restrictions and everything is so stringent that I would think that the only problem with the retail investors, they are impatient. So if they become patient, if they are patient retail investor, they've made entry at the perfect time. But if they are impatient, they want this kind of a kick of last 3 months. In every 3 months, I think they'll be disappointed. So that impatience will take their all the whatever they have made. So I would suggest that they should become a little more patient, learn the game, and beat the professional on their own track.
We've done 25 minutes plus with you, almost 30 minutes. I'm not impatient to wrap this interview. But I have a compulsion to wrap the interview, and which has got time and importance of a commercial break. So we leave it here, Mr. Agrawal. Stay safe. Thank you for very much, and certainly hope to see much more of you going forward.
Thanks, Nikhil.
Let's take a break. It's a good-looking market in pockets. Tata Motors is up, Thyrocare is up, CG Power is up, Z ahead of numbers is looking strong. So you got to pick your spots in this market. No point in taking a very nuanced view on the Sensex or the Nifty, at least for the day.